Hello again, everyone. Gerry Hogenhout here. Welcome to another one of our episodes of our tax and investment snippets, where we take a topic, a tax topic or an investment topic, and we just chat about it for 5 minutes or so, just to give you a little better understanding. Today we're going to talk about a typical structure between a taxpayer and a corporation. Why? One of the reasons, there's many reasons to use corporations. We're just going to have a brief little chat about one of the real benefits of a corporation. There's two reasons to incorporate. One is legal liability, and the other is tax. Okay, so there's in general, we want to make sure there's tax advantages if you're considering incorporating. Again, a corporation is a separate legal entity, so a lot of time people will incorporate just to separate that liability from themselves personally to the corporation. So that's a good reason to do it. The tax reasons, there's usually many good reasons to utilize a corporation. The big one is the tax rate. Corporations pay tax at 12.5%. 12.5%. Okay. Individuals, taxpayers, can pay up to 50%. Okay, so that's a big potential tax savings. Okay, so a lot of times if we do incorporate, we keep the income down here. We have a lot of control with how that income goes back to the taxpayer. We have to cross our tax line, so when we take money out of a corp, we have to cross our tax line and pay our tax. There's different ways that we get money out of a corp. One is a management wage. A lot of times we'll put the taxpayer on a salary from the corporation. And I usually try to keep the salary very low. I try to keep that salary in a low tax bracket on the personal tax side, if we can. So a salary is taxable to the taxpayer, deductible to the corporation. Another common way is dividends. Okay, dividends is basically the after-tax payment from a corporation to a taxpayer. So what I mean by that is the income is earned in the corporation, we pay our 12.5%, and then we can flow a dividend up to the taxpayer. A taxpayer can actually make about $45,000 as a dividend without paying any personal tax, zero, nothing. So if you follow that math, if we earned the income here, paid 12.5%, gave the taxpayer a dividend of $45,000, we pay no personal tax. So we've earned the income, we pulled the income out of the corp at a 12.5% tax rate. That works great. We can do income splitting with spouses as long as they're involved in the business, so there's new rules around that. We can income split with kids still. They have changed the rules around that. It's a little harder to do, but in certain circumstances we can do that. So the ability to pay owners a dividend is a huge tax benefit in a corporate structure. I actually like corporations. Those that know me know I'm not a big fan of RSPs. I like building up our future earnings in a corporation for later on in life. Much better, much more tax efficient. Now, when we do that, we want to take money out of that corp. Okay, again, we set up a corporation for tax reasons, 12.5% corporate tax rate, and legal reasons. Okay, so if there's a legal problem in this corporation, they can't come after the taxpayer, but they can come after the assets of the corporation. So if the corporation is successful, if it's making good money, we want to get the money out of this legal entity, and we really don't want to cross the tax line yet, and that's where we use, bear with me, that's where we use a holding company. Okay, we're still underneath our personal tax line. Taxpayer owns holding company 100%, holding company owns corporation 100%. So we do a little corporate restructuring to get the desired structure. But in theory, the corporation is still earning the money. It's doing whatever it's doing, whatever business function it does. It earns income, it pays 12.5%. We can flow the money from this corporation into the holding company by way of what we call an intercompany dividend. It's tax-free. We can take the money from here to here, no tax. So now all the money is in the holding company. It's away from the operating company, which is what we want to do, because the operating company can get sued. And if something happens from a legal liability point of view, we really don't want any assets in this corporation. We just want it to do what it does. We want it to invoice, do the sales, and any excess money, we want to get it up here to the holding company. Okay, in my world, I use holding companies as my vehicle to save for my clients' future. I do not use RSPs. I do in certain circumstances, but not generally. I like building up as much money as we can in a holding company. And then we could take it out to the taxpayer, cross our tax line. There's many different strategies that we use to get that money out of the holding company into the hands of the taxpayer throughout their lives. So just my opinion, I think creating a corporate structure with a holding company is a very strong vehicle for tax planning into the future. It has to make sense. There's obviously costs associated with it, setting up these structures. The costs, the benefits of setting up these structures have to exceed the cost. So there's no point in doing all this stuff if it's just costing you money that you're not getting a benefit for. But in most cases, the benefits far exceed the cost. Anyway, I hope that helped a little bit. Always glad to chat further about these topics. Feel free to call us, visit our website, Canadian Investment Service. Thanks for joining me today. Have a great day. See you again.